Morning, Chris. How you doing?
Hey, Brian, I'm good. How's it going, man?
Everything's good. This is Brian Jones. I'm here with Chris Hood, professional trader, world's most interesting man.
World's most terrible hairstyle.
Nah, it's looking all right. It's looking all right. You
I
had
don't
some,
know, man. I don't know. It seems that COVID has done something. It's either made my hair grow a lot faster or it's just made me less tolerant for bad hair. I don't know.
well, it's at least it's not like look at this gray. I got all this gray here.
Hey, embrace it. I told my wife, I'm looking forward to the grays when they come. There's a couple that are coming here, and I'm okay with that. I'm okay with anything that happens on the aged side. I'm fine with that. I don't mind.
I've been told that gray is not bad, so
No,
I don't really care. I can't do much about it anyway. So
it's not bad at all. Makes you look distinguished and experienced.
nice.
That's what I say. There we go.
That's a perfect. I like that look.
Yeah, distinguished and experienced. Much better than young and immature.
So what we were just chatting a second before we started and the market, man, I'm still sort of like I'm not trading a lot. I'm trading very, very, very small and
It is
kind of waiting.
crazy time, man. This is normal. So let's just put things into context. This is not unusual. It's pretty much exactly the kind of environment that we've been anticipating since May. So this is not something where everyone should be shocked and surprised. It's not like that. But it is a really difficult time to trade. And if you go back a couple of weeks, I was saying to people, just be light, be nimble. Don't overload anything. This is not a time for heroics in any way, shape, or form. This is not a market you want to try and catch because there's a lot of head faking going on. This is like two boxers in a ring and you're waiting for someone to flinch. And the guy who keeps flinching keeps getting hit on the rebound back to the middle line. So, if you're a trader, the best strategy I'm seeing at the moment is just day trading. If you can stay away from these opening gaps that tend to swing people out of trades, it can be really useful for your P&L. However, be careful because these things are not real. A lot of the movements don't seem to stick. And we're seeing this at certain time frames. The big gaps up are not holding at key points and they're reversing really fast on people. So you've got to play it safe. You can't just go into the market and expect it to behave the way you want it to be. You've got to be a little bit more flexible, a little less, should we say, ambitious on your goals. Try and bring them back a little bit and just appreciate where the market is. This is normal for this type of year. And, if you've been trading, let's say 2 to 3 years, you've never seen this before. This is very new for a lot of people. If you think pre-COVID, a lot of people only got into trading, when COVID really hit 18 months ago, right? Those people have never seen a market like this. They saw the COVID crash. They came in at the bottom. They've just seen up since the COVID crash. They haven't really seen corrections. They haven't really seen down markets. So it's just a very new experience for a lot of people. Play it safe, man. This won't last for long. There'll be a couple of weeks' time, we'll see things start to turn around. We will get that Christmas rally. I think we'll get it. How big it will be is hard to tell because I'll show you a couple of things here. When you look at the forecast that we did on the market back in September, in fact, let me put it up here. So on September 23rd, we did a forecast for where the market's going to be on October 15th, right? This week. Now, on September 23rd, we predicted the market will be somewhere around 4235, okay? And we were pretty much on track for that up until Thursday last week, all right? Thursday last week, we got these two, this was Thursday, that was Friday, this was Monday, right? But look what's happening. We are failing right at the mid-range or right on the line of the 34. Okay, so this is the 34 EMA wave. Here we are failing right at the line. We passed through it, we failed, we failed. This is key. Now the question is, well, where does the market go from here? All right, does the market continue to drop down to 423 and make our prediction from 23rd of September accurate? Or is it going to bounce off this support line here at 4368 and go back to the upside, right? So on September 23rd, the market could either have gone up to 4530. I think we can rule that out. And I think we have to rule this one in. I think this is where the market is heading. Now, could it drop another 60, what's this, 140, 130 points between now and the end of the week? Absolutely. All right. And this is what makes trading so difficult, is that you get suckered into these kind of movements. We had this movement here. This was that Monday crash. There was this recovery. Everyone got suckered in going, well, let's buy the dip. And they bought the dip, and then they got hammered. By the next week, they were already losing money. Then they buy the dip again, and that failed. And then they fell down even more. We reached the bottom of that Monday here. We thought, oh, well, we're just retesting that level. Let's buy it back. So people buy it up, buy it up. You can see the candle here was a little bit higher. Buy it up, fail. Then we do it again, fail. Now, is this another fail? And will we get down to this level? So this is where I think we're headed. Now, we might be 1 or 2 days off. Could we see this level by October 20th? Maybe next week we'll hit that level. But I certainly think because of the failure here, we are going this way. The path of least resistance continues to be to the downside. Now, what does that mean for trading? Well, you've got to be really careful, because we have a lot of price inflection points that are hovering around the zone where we are, right? We've got the 8, we've got the 13, we've got the 8, the 21, we've got the range of the 34, we've got the Fibonacci levels as well. You can't make predictions. This is where it becomes really difficult, is you can't play a trade or a trend without knowing the direction of which that trend is going to go. And as far as we can tell here, with this yellow shading, this is telling us we're neutral. We have no clear direction, whether the trades are going to go, or whether the direction of the market's going to be back to the upside or continue to the downside. So in these kind of markets, what you've got to look for is confirmations. And we need to have certainty, because as traders, we don't trade based on, this looks good or this feels good, so I'm going to do it. What we try and do is we base our trades on probabilities. What is the higher probability trade here? So based on this graph, the higher probability trade is a trade to the downside. So if we start trading to the downside, if we start building positions, what are the most practical ways of playing to the downside? Well, the first thing is you've got to think of expiration and time, because this could reverse on you. And this is why I get nervous trading close to inflection points. I call these inflection points because price tends to behave slightly differently around these levels. And what price can do is it can reverse on you. It's Murphy's Law, right? I take this position and I'm saying, that's it, it's going down here and it's going to be there by this date. And as soon as I buy in, the price will actually go the other way. It happens many times.
Yeah, Murphy and I are really good friends.
Oh yeah, Murphy and me are neighbors. He lives next door. And I'm sure the guy next door is moving the market. I don't know. But this is the danger of playing around inflection points, is you have to have a higher degree of certainty that your trade strategy will play out, right? So what are we seeing here? We're seeing a fail at this level here of 4414. The market really struggled to get over the 4400 level. So we could play this via a call credit spread. All right, there's a play here that you could do a call credit spread, but you'd need to be very careful about what level you're going to sell short, because if we bounced hard, all right, so if we got like a V here and this bounced hard, that call credit spread would get wiped out. All right, so you've got to think about duration and you have to think about the credit you receive. The risk reward needs to be correct. If you're risking 5 grand, you do an SPX trade, you're risking 5 grand, 10 contracts, 5 wide, and you're only getting, $800, that risk reward would not be appropriate, right? Because if that reverses on you, you're going to lose 4 to 5 times more than what you're actually going to be making. So the safer trade would probably be, in my book, it would be a 30 delta call option somewhere for November on the play down to 4423. All right, so a 30 delta call option, a 30 delta put option, like a bear put spread, playing down to this level, 60 to 90 days out. All right, so you've got to give yourself enough time to be right, because we will see bounces. We're going to see these V shapes, right? And if you're in a bear put spread that's close to the money, you're going to drop your 25% or 30%, whatever your stop loss would be on that trade, fairly quickly if we had a V shape sort of bounce. And that's the vulnerability that you have here.
I have a question really quick.
Yeah.
I know you like to do bear put spreads, and also you do some long puts. And what's the advantage? And you've mentioned this, but just for the audience, what's the advantage of a bear put spread over a long put if you're playing for the downside?
The bear put spread just has minimized volatility because you've got that short put, you've got the short put that's actually lessening the effect of volatility, right? So if you're playing a long put, your delta of the position is going to be a lot higher. So whatever the movement that's going to be is going to translate into a higher return on the long put by itself. If you're buying a bear put spread, there's two reasons I do it. One of them is affordability, because the short put credit actually reduces the cost that I've put in. So it reduces the overall economic cost of the trade. And two, it just reduces the volatility. All right, so my upside is a little bit limited. I've controlled myself to the upside. So those are the only two major distinctions between going long put or bear put spread. I want the same thing in both. However, if I hold a long put, I need a more dramatic movement earlier in the hold of that trade. Because remember, when I've gone long, I've got theta that's eroding the value of that position every single day that I have it. So if I buy 30 delta 90 days out, I don't really pay for that. I've got this volatility kicker that's in the trade. If there's a big movement down, that delta is going to increase dramatically, right? So it's almost like the sweet spot of buying a long put, right? I don't really like buying in the money long puts. They tend to get killed pretty quickly on reversals. So I avoid buying puts close to the money. I do find hedge trades, all right, and I use the inverted commas and air quotes because hedge trades are, for me, a bit of a waste of money. You either trade directionally or you don't trade at all. All right, hedging seems to be, if I go back and look at my book, hedging is the most expensive trade that I have because it costs you the most money most of the time, right? It's the one that doesn't really make you a lot of money. All it does is offset losses in another part of your book. It's not really designed to make you a profit. Otherwise, that would be a trading position as opposed to a hedging position. So for me, I like to use both. I tend to sometimes use them together because when I look at the delta of a position, it's all about adjusting it as the trade develops in order to get the maximum benefit of the directional call that you've made. Right, so if I'm making a call to 4233, but I'm a little bit nervous that it's not going to be correct, I'm going to go with the cheaper trade, which might be a wide put butterfly, right? It might be a very, very wide put butterfly, 30 days out, 50 strikes, $50 wide on each side, costing me $100 or $200. That just gets me into the trade, and I can make some adjustments as we go along. I can always add to that trade. All right. One of the other ways to do it is to start with a bear put spread and then use a bull put spread underneath that bear put spread to finance the transaction. All right. But it's got to be underneath. So if I've paid $2 for a bear put spread and I finance it with a $2.50 bull put spread underneath, remember, price has to drop through my bear put spread before my bull put spread starts to lose money. All right, so remember the delta on the strikes above is going to be higher than the deltas of the strikes below, which means I can actually lock in a profit and reduce my capital at the same time by using those two strategies at the same time. But they've got to be underneath, right? You can't finance it with something above. So if the price reverses on you, you've got to make sure that your protective position, the one that's actually the debit, is above that bull put spread. So there's different ways to play it. You can start off, the way that I try and teach guys is always build your story first, right? What is the story you're trying to play? So for me at the moment, since September 23rd, the story that we've been playing has been to the downside, right? So we've had bear put spreads, we've had long puts, we've been using short duration call credit spreads, we've been using a lot of things playing the story, all right? This is the story that we're playing. Now we get to a point over here where the story might be changing. The plot has thickened. You know, the chef did not kill the owner of the house. Okay, this is now we've taken you down a path, and now things are starting to look a little different. Could we still be trading to this point? Yes. The reason why we failed here, and if you look down at the bottom, we have the B score sitting below 50, the squeeze firing to the short side on the momentum, and our alpha score is below 70. So we've got enough validation underneath to say, look, the market's probably going to fall down to here. Will it get here on the 15th? Probably not. You know, it could, but I doubt that it will. I think that the bulls have to come out and start showing their hands. Yesterday, it was like two boxes fighting each other, and the underdog was just flinching the whole time. The bulls are the underdog in this fight, right? So the bulls need to come out and actually start throwing a few punches. You can't just sit there in the corner and take shots to the head, all right? And that's what's happening at the moment. Yeah, you're going to get knocked out at some point, right? So here's the other thing. When you start looking at, let's say, this is the daily chart on SPY, right? So I've gone a little bit further now. I've said, okay, we've got SPX that we forecasted on the 23rd of September down to 4236, somewhere around there. And SPY, which I've done this morning, looking out to the 22nd. So I've gone a week later, right? For SPY, the market is either going to be sitting down here around 424, or it's going to be up here at 445, right? So that's a 20 wide spread that's from today's forecast, right? We're going to open at 435. We're going to open up below yesterday's close. So we're going to have a gap down, not a gap down. We're just going to open up a little lower than yesterday. But the market's got a lot of work to do, because if we're going to be achieving this trajectory, we need to close above the high of yesterday, which is 4430, 440.1 now, okay? If we are going to be heading towards this trajectory, look what happens. We need to close below the low of yesterday, right, which is 43465. Okay, if we open up the chart and we start looking at the momentum, what we've got here is we've got some bullish moving averages. We've got a negative B score. Our squeeze momentum is to the short side. Our overbought, oversold indicator is telling us it's a buy, and our alpha score is below 70. So with that, what we've got to be careful about is this red line, right? This line, 432, all right? If we fail at 432, which is the 23.6 retracement level, right? If we fail here, I have absolutely no doubt that we're going to do that, right? So this line has to hold. If this SPY candle for today holds at 432, so we'd need a confirmation tomorrow. We'd need to stay above it tomorrow to give us confirmation. We could bounce off the line and go this way. We could do that. That's still a possibility. Or we're going to fail on our second attempt here, and we're going to slide down to 426, 423, somewhere over here by next week. Okay, so this is all for next week. Now, my personal favorite is just fall. All right, just, you know, the slow bleed whipping, you know, Chinese water torture kind of thing. I'm not into that. I would rather have this as a sort of, you know, let's just do it like that. You know, single gaps down like this are much healthier in my view than the slow bleed grind chop nonsense, because the slow bleed grind just becomes hard to trade, right? Because you've got no spaces to play towards, right?
Right.
So
it keeps bouncing back up.
Yeah.
Like it keeps bouncing back up and falling again. It reminds me of like when I was a kid. I did Taekwondo, and I don't remember how old I was. I was sitting in some fast food restaurant, and it's kind of like a trader going in on one of those upward bounces. So I was really mad at somebody over something. It was one of my friends, and I decided I was going to like karate chop, you know, knife hand his hand.
Yeah.
And then he moved it. And so I just hit the edge of one of those really hard, I think it was like McDonald's tables, and broke my hand. He thought it was hilarious. I didn't.
Well, it's an interesting point that you have, because these movements are head fakes, right?
Right.
Like I got calls from people on this Monday that were shorting the market down here. Okay, they started to load short somewhere around 430 there, and this move killed them, took them out. And look what happens. You short the market, you get bounced out. 3 days later, it happens again. Right? So you close your short probably at the high of the candle before. So you would need to probably get out somewhere here. Right? This would have been your exit on a short, right? Everyone reads the same books, right? So everyone's got the same level of shorts. So they go short here, they're out, right? They've taken themselves out. Then it happens again. They go, oh, well, let's short the market here. They short the market there. They start making some money. They go, oh, thank goodness, I'm going to make some of this money back that I lost over here. And they get wiped out over here. And it's the same thing on the long side, right? This happens. People go, oh, crap, what do I do now? They get to this candle and they say, oh, everything's okay. We're above the lower range of the 34. I'm going to go long. They go long here, get wiped out there. Then, or they hold on, they get more wiped out later on. They see this bounce. They go, oh, let me average in. And they average in on this candle and then they get wiped out again. This is why it's not a market for heroics, because these candle patterns are pretty normal, right? Remember, gaps down tend to get filled. What happened here? We had a gap down that got filled. What happened here? We had a gap down that got filled. What happened here? We had a gap down and it gets filled. Look at this. It took 1, 2, 3, 4, 5, 6, 7 days to fill this gap. There it is there. So you've just got to play it safe. I would say whenever you start building your story, understand the underneath scenario, right? What's happening underneath? If you just look at this chart, it would be pretty easy to just sit here, look at the chart and go, you know what, this is not a stock that's going up. Right? Just if you look at this chart, this is not a pattern that's going up. So that's pretty visual, right? It's pretty easy to see. Where you've got some extra stuff worth looking at is when you start looking at the underlying, right? So you need to measure a couple of things, right? So I watch the futures on a minute-by-minute basis. I like to see what's happening underneath in the futures market for both NASDAQ and SPWR. I look at the ticks. I want to see if the ticks of the market can be sustained above 1,000. If we're getting a rally in the market and this is not going above 1,000, it's not staying there, I don't buy into the rally. It's not worth buying into it. All right, it's going to reverse on you. So you have to pay attention to what the heartbeat, the EKG of the market is. Then when we look at the SKEW, this tells us the level of insurance that hedge funds and large players are putting onto their portfolios. So when they are insuring their portfolio, they are saying, you know what, it's going to get worse. When they get to a level of insurance that tells us the market's going to start reversing, okay, and my level is around 1.2, it can't get more extreme than that. When this gets down here, that's going to be the buying opportunity. All right, that's when we start going, okay, now we've reached the bottom. Okay, so I watch this to determine where the bottom is. Then we've got to look at the outside markets. We've got to look at what sentiment is being infected into the US, right? So remember, sentiment is not driven just by what happens in the US. There's always this flow over from Asia into Europe, Europe into the US. Look at what's happened to Germany over the last couple of weeks. Okay, so if we look at this, we had this fail here, rally back to the 34, fail, rally back to the 34, fail, rally, fail. This has been in a downward trend since September. Here was the sign telling us that things were going to get pretty rough. It was back here. Right? And I think I mentioned it to my subscribers. When we start seeing these kinds of candle patterns at strong levels, where we see failures to reach new highs, that's the warning sign that you've got to look for, right? So this is how we look for sentiment. I want to see what's transferring from across the world into the US market. The next thing we start looking at is interest rates. If you want to know whether NASDAQ is going to get hammered or not, you want to watch the interest rate on the 10-year treasuries. And what we've seen since back in September, look at the dates. So if we go back 7th of September, look what happened here. There's 7th of September on the interest rates here in this little graph here in the second from the left on the bottom. 7th of September, look what happened. From here to here, look what happened on the 23rd. We could see the decline of the market coming because we started seeing rises in interest rates. The market in the US is not going to rise unless those big tech companies rise with it. All right, the financial sector and the energy sector aren't strong enough to carry the whole market. You have to have big tech moving to make those movements stick. Then what we do is we also look at volatility. Now I look at two measures of volatility. The first one is volatility by itself, which is the bottom right, which is the VIX. We can see the VIX is calming down. You know, it has spiked up to 25 over there. It's now there, it was up at 30. I have a level of around 17.5. If it can keep itself at around 17.5, this will tell us whether or not we're going to get big movements in price, sell-offs, etc. Right? How do you know if those are going to happen? Well, what you've got to do, this is really weird. This is the volatility of volatility. Okay, and then there's the volatility of volatility of volatility. And we can make this like a Monty Python skit where we could have 15 volatilities of volatility. But very simply,
sounds a lot like calculus. This sounds a lot like calculus, Chris. It's scaring me, man.
So basically what this is telling us is whether there's an opportunity for an extreme movement in volatility, right? So if the volatility of volatility is sitting up at the top range of the Bollinger Band, it tends to revert back to the mean. So the probability of a movement starts to decline and we start seeing drop downs in volatility. So this will tell you whether or not the market's going to sell off. I don't think we're going to see sell-offs. What I think we're going to see is choppy grind lower. That's normal for this time of the year. So as a trader, you have two choices. You can either stay in the game, you can play the trade, or you sit back, wait on your, sit on your hands and wait for the market to be the setup that you're good at. Once you get the setup that you're good at, trade the setup. Don't, fret about the stuff on the outside, the peripherals you don't control. Just wait for the setup to come that you trade and you trade it. So a lot of people try and chop and change and, adjust their strategy on the go. And that's never going to be useful, because what you're doing is you land up not recognizing certain parts of that strategy that are going to affect you. So you've got to remain consistent with your rules. You've got to use the opportunity that the market provides you now to really know what you're looking for the rebound. So I'm telling my clients, start looking now for signs of reversal. You have to know what you're looking for so that when it happens, you can get in early on the trades. So there are a couple of trades, that are looking relatively attractive. I'll bring them up here. So the first one I like, and the first one that I watch is Google, right? So if we look at Google, yesterday's candle was within the range of the candle before, a little bit down. So we've got B score going above 50. We've got some sort of lessening of downward momentum, although it is firing to the short side again. And our our alpha score is at 60. Could this give us indications that Google could be ready to move back to the upside? All right, so I think Google is certainly going to be in play for the 3,000 level at some point in the next 2 to 3 months. Whether or not that happens in the next 2 weeks, I don't know. But it's something that I watch every single day. So
what about earnings?
Google does tend to rally into earnings. So, if you think about earnings being on that date over here on the 26th, could we see Google rally into earnings? I think it's possible. I really think it's possible. But you've got to play it safe. Like, would this be the opportune time to actually do a trade? No, because I need this to be above 70 and I need this to start going to the upside. Could this be going to the upside? Yes, because my B score is above 50. So I certainly have some signs of something here, but I'm not going to be rushing into doing anything big on Google. I do have some trades on Google that expire next year. Once we get through this period here, I think that we should be pretty good on Google. So Google's one of them. Another one that I really like is uranium. This is looking very attractive. This kind of pattern that you see here where prices become range bound. Okay, this is the daily chart on URA. This is the ETF that tracks the price of uranium. When you start seeing prices tending to consolidate within a range, whilst the squeeze is actually shooting to the short side. So when you start seeing price behaving differently from where the indicators are telling you the price should go. So there's this disconnect, there's this divergence between the indicator and price. It can often be quite a bullish or bearish scenario, depending on what you're seeing. So from here, you know, we're trading right at the 8, the 21, and the 34 upper range are all pretty much compressed together here. All right, this could go either way. I would say you have to look at the trend that preceded the consolidation. Trend that preceded the consolidation was green. I think that we're going to be moving back to the upside once this fires to the upside. So what I'm looking for here is a movement above 50. So I'm just going to put my alert on here. Done. Now I wait. And when that shoots off an alert for me, I will go in and trade it. Another one that looks pretty good is XLE. This looks fantastic. Although we are seeing quite a distension here between the 8 and the price, right? So you can see this extension on price. This little red hat indicates to me that price will come back at some point. It doesn't mean it's now. It just means that price is extended above the third Keltner on a number of time frames. So from here, what I'm looking for is price to pull back to the 8. All right, profit target sitting up here at around 59. We've been in this trade since we got our buy signal down here on the 24th of September. So we've been building this position on these pullbacks here and here. So now it's a question of just, you know, gracefully exiting the position for some profits. When we look at XLF, XLF looks fairly similar, although we're still yellow here. There's still a yellow on our trend. We've got a B score above 50. Our histogram is positive here, and our alpha score is above 70. So XLF looks good. Just be careful. A lot of the constituents of XLF are now having earnings this week. So, you know, you've got to be a little bit wary about how earnings will affect the ETF. You know, and a lot of the banks tend to do pretty badly after earnings. So you've got to be careful about that. But really nice looking setup here. We've got, you know, this was our buy signal that we started to get in. We averaged in a couple of trades over here. We are profitable on our XLF trade. So those are two that look good at the moment.
I've noticed that a lot of the alternative energies, solar and everything has done reasonably well, but I sort of missed it. I wasn't watching closely enough to get into the trades whenever they exploded.
Yeah, SunPower was the one that we did. I can't remember the date that we got into this trade. Give me a second. I'm going to have a look at it here. We got in, I think it was over here, actually. I think we got in over there. Let's have a look. Yeah, it has been pretty good. I mean, at the end of the day, I think the way that I like to trade is pretty much around, you know, I take the signals as they come from the way that I've built them, right? So a lot of these indicators here are based on my plan and my strategy, right? A lot of it is around moving average crossovers, particular time frames, and extensions. So, you know, I like to get in on momentum and price reversals and get out on extensions. So this is a pretty accurate system for me. You know, looking at SunPower, we've got a Jan 21 call. We're up 40%. We got in on the 27th of September. So we got in here, right on that candle there after this signal. So we looked for the confirmation. There was our confirmation. We got in. And we've been in it for, yeah, since the 27th of September. So, you know, what's this, 2 weeks, just under 3 weeks. Now we are at this extension of price. So now the question comes in, well, should we take profits? Should we be adding to the trade? So if you're going to add to the trade, you really want to try and add somewhere down here towards the 13, the 8, the 13, 21, 34. Those are your levels, right? So you want to be adding in at these points. Any addition to a trade at the 8 is aggressive. So you don't put your whole trade in on there. You put maybe a third of your trade, maybe half of your trade. If you're looking to hold it for the next 3 to 4 months, you know, you've bought a 6-month option or a 3-month option, you're going to hold it for a month. You have to put these price points in, because if you just chase the trade, look, this is going to open up here at 26.53. All right. That's not a price to pay 100% of your trade, because if we've already got an indicator telling us that price is going to reverse, you're going to overpay up here, and when it does pull back here, you've lost money. And all the guys who actually followed the rules of buying in closer to the moving averages tend to, win. Will the price pull back? Absolutely, it's going to pull back. When? Who knows, right? But the point is, put your alert on here at the 8, here at the 13, or at the 21, or at the 34, and wait for that pullback. And when it happens, go in, look at the data underneath, look at your B score, look at your squeeze, look at your alpha score. If they all still stack within the setup that you're entitled to trade in your plan, do the trade. That's how you do it. So looking at the market, if we look at the market from a sectoral perspective, there really isn't much to go on. You can see here, the dominant color here is red. There's just nothing around. If you look at how many you can't trade in biotech, there's nothing in healthcare, zero in utilities. I would be avoiding any of these sectors that are double reds for now, regardless of how good the individual constituent looks. Just stay away from it. It's not safe. I would be putting my attention here. XLE, the gas environment looks fantastic. XLE looks really good. If you look at the futures on gasoline, you can see that this is going to 100. Oil is going to go to 100. So with oil going to go to 100, obviously that's going to have a translated effect into energy stocks. So energy, finance, gas would be the only ones that I'm looking at. There's finance. Those are the only trades that we have right now that are appealing. But this is my watch list also for where there's green shoots, right? So when things start to turn around. So what am I watching to turn around? SPXL, SOXL, SMH. Nothing's going to happen without semiconductors. So you need semiconductors to sort of be part of that rally at the end of the year. I'm looking at XLC. I'm watching all of these trades on a daily basis to see where they start having compression. I want to look for squeezes, and I'm looking for less reds. All right. So as soon as these things start to improve, the 8 to 21, 21.34, 34.55, and we clear the 8, right? So this is below the 8 SMA. Once we start clearing the 8 SMA, we can start seeing green shoots. So you've got to start building for that. I think that's the important thing for this period. It's not worth throwing money at bad trades. It's just, if you're a bullish trader, wait for the bullish setup. Don't try and trade a bullish strategy in a bearish market. That's a recipe for a loss.
That makes sense. Excuse me, I've still got the cold. I'm working with it.
The cold.
Yeah, the cold, the strep throat. It's all sort of merged. I had allergies that sort of merged into strep throat, so I've been worse for about 2 weeks now.
You should stop rolling with young people. I think that young people have a conspiracy against us elderly folk.
Yeah, it's one of those. I think so too.
They don't beat you with technique. They beat you with viruses and bacteria.
So I noticed that, are there any earnings plays that you're looking at though? Like, do you think, is this a bad quarter for earnings normally?
I think earnings have to be sort of, you've got to take it. I would prefer not to trade earnings.
What about the run up to earnings?
You know what? The problem that I've had over the last maybe 6 months is that I had a bit of a disaster with Amazon at the last earnings. Amazon had done something every quarter. There was the assumption it was going to do it again. And then we had a 3 standard deviation move on earnings to the downside. And I had sort of, gone to the upside. And it was a very expensive lesson that, earnings it's like a crapshoot. I think that it's safer to rather just wait. If there's earnings within 9 to 14 days, just stay out. At this point, it's a 50-50. I think that it's safer not to play a 50-50 trade. I think it's better to just wait. The fourth quarter is going to be here in 3 weeks. Oh, sorry, the the fourth quarter rally. November will be with us in 3 weeks. You just have to sit back for 21 days. It's not that long. You know, in the context of trading, it's just, you know, it's much safer to just sit back, refine your trade plan, make sure you've got your watch list refined to the point that you could actually execute trades if they came away or came by, and know what you're looking for. You know, earnings, is it going to be up? Is it going to be down? Who knows? I mean, I sort of got shell shocked the last time I traded it. I'm just going to avoid it now. It's
Right.
not worth it for me.
Well, that's good stuff, Chris. Well, I'm going to let you go and get about your day and get your trading going. So I appreciate your time.
Thank you, my friend. It's always good to see you. And shout out to my friends in Las Vegas. If you're there, this is the place you got to go and train, man. It's a good place.
Yeah, definitely. And guys, go check out Chris's Alpha Hunters project, Alpha Hunters product on Rogue Investing /alpha, and get involved in this so you can get some coaching. So thanks again, and we'll see
You're
you
welcome,
next
my
week.
friend.
See
Take
you
care.
later, Chris.
See you next week.
Yep.
Cheers.